Hello and welcome to this premium edition of Wealth Track. We have a special treat for you this week on Premium, the full and uncut interview with one-of-a-kind investment legend John Bogle. Jack, as he is known to many of us, is the founder of Vanguard, the low-cost investment giant famous for the index funds which he created there in 1976. His first index mutual fund, now named the Vanguard 500 Index Fund because it is modeled on the S&P 500, has over $100 billion in assets, as does its equivalent fund for institutional investors. If combined, they would be the world's largest stock mutual fund. So Jack, it's so great to have you here. Thank you so much for coming.
My great pleasure to be with you again, Consuelo.
On Wealth Track, we really appreciate it. So let me quote from your 1951 senior thesis at Princeton. And when you said, only if we serve individuals and institutional investors in the most economical, efficient, and honest way possible can we again honor the standard of fiduciary duty that once largely prevailed among trustees of other people's money. So take us back 60 years when you started in the business. What was it like when you started on Wall Street?
Well, it was great. Actually, I didn't, technically speaking, start in Wall Street. I came to work for Wellington Fund, one of the original mutual funds going back to 1928, with a wonderful Princeton graduate, Walter L. Morgan, the founder of the Wellington Fund. And he hired me in 1951 when I got out of college. And we had, the two things were very different about the fund industry then, and the change in those two things had made a huge difference in the development of the industry. I call it in the book, the change in the mutual fund culture.
Right.
One is, we were small as an industry. Wellington Fund was probably one of the 10 largest funds. It was $140 million. We probably employed about 40 people in the company. And we had one fund. And so everybody knew, the research people, the administrative people, the marketing person, everything was focused on that one fund. That was our other people's money. And we had a fiduciary duty to those people, and we honored it very well. Wellington Fund was noted for low cost, noted for balanced investing, mixed between bonds and stocks, very consistent over the years, and very much dedicated to serving the investor. Long-term investment philosophy, very low portfolio turnover, and I and anybody else that was working there got the history of the fund, how it got through the 30s, how it got through the 40s, post-war period, all the way up to 1951. And it's kind of interesting that I got there in 1951, and here it is 2012, and I've been there ever since. Now I'm just a senior chairman right now. I mean, I'm sorry, honorary chairman, I've been associated with that one fund all that time, and I know it like the back of the hand. There's a good story there if we can talk about it later.
We will.
That's one big distinction.
So let me just stop you there for 1 second. So when you're talking about you knew you had a fiduciary duty to your shareholders, what did that mean to you back then?
Well, that's a great question, because I'm not sure we used the word fiduciary. We might have used the word trust, but we knew what our job was. It was to serve the Wellington shareholders. And that's, if you actually just understand that concept, that came first. And that's in the form of a sound investment program, a careful one, a long-term focus, and very low cost. And if you don't have those kind of things, you're not observing fiduciary duty, and you're not earning the shareholders' trust. And so the fund burgeoned in growth. But what happened to the industry is it went from, back then, $2.5 billion to $12.5 trillion today. It grew up.
Big business.
Big business. Then it was pretty much organized by professionals who ran money, not marketers.
And you talk about the distinction in the book that you talk about, this clash of cultures, is that there's an investment state of mind and an investment profession, and that you're saying that profession has now become a business and it's become one of speculation. So what's happened? Take us through the evolution, because again, you started in 1951 when it was small and it was fiduciary and it was a professional investment business.
Okay, run by professionals with marketing divorced from Wellington happened to own a subsidiary that did the distribution, but many funds, big funds in the business, had nothing to do with distribution. There was an outside distributor working on its own, making money off sales commissions and sales loads in those days by selling the fund. And so it really worked pretty well. Marketing was over here, and management was over here. Salesmanship was over here, and stewardship was over here. And to just moderate the phrase you mentioned a minute ago, in those days, it was a profession with aspects of a business. Today, it's a business with aspects, and I think too few, of a profession. Now that change comes by growth. The old mom and pop professional industry becomes a great big industry run by not investment professionals, but by corporate managers, and in far too great an extent. And it also happens along the way that instead of one fund, you now have a large fund complex may have 200, 250, even 300 different funds. How can a fund director have fiduciary duty to 300 different funds? Indeed, a little bit tongue-in-cheek, how many mutual funds directors can name all of the funds they're directors of? And I will tell you the answer to that question is 0. So I have a little lower test. How many fund directors can tell you the number of funds that they're director of? And I guess the answer to that might be 0.1%. So the idea of fiduciary duty has been superseded by this idea of marketing, making things that will sell rather than selling what we make, is the way I phrase it. And so if a bunch of investors seem to want some new kind of a leverage thing, or short-term focused fund, whatever it might be, give them one. I mean, think about this for a sec. What is marketing? Marketing, the classic definition, is finding out what the public wants and giving it to them. I could spend 100 years trying to find a better definition of what a mutual fund company should not be.
So what should a mutual fund company be? And you founded Vanguard, which is now a very large mutual fund company, and it has many different funds. So, what should a mutual fund company be? Is it possible to still have a fiduciary standard among the money managers and still have a big marketing arm that really doesn't have a lot to do with the money managers except to represent the funds that they're managing? I mean, can't you do both?
Well, it's very difficult to do both. The fund, just to be clear, the management company has its own officers and directors. And they're often, maybe the vast majority of mutual funds have management companies that are owned by financial conglomerates. And these financial conglomerates are in business to earn the highest possible return on their capital. And what you want as an investor in one of their mutual funds is to earn the highest possible return on your capital. So when you think about it, those two things, because of fees and cost and turnover expenses and all the things that go on in marketing, are opposed to one another. You can't do both, or as a book we've all read carefully says, no man can serve two masters. So the structure of the industry is inherently flawed, and it will have to change.
So, Jack, let me ask you about then, realistically, we have as you said, it's a $5 trillion industry now.
Yeah, 12.5.
Or 12.5 trillion. And so, realistically, how you're saying it has to change. How does it have to change? And realistically, how can it change? Let me start there.
Okay, I'll give you two answers, two ways it can change that I've thought of. One is what I call the Adam Smith solution. And that is if each investor looks after his own best investment interest and puts the money with the firms that best serve his own interest, then the industry will change. Because he's going to demand a long-term focus, he's going to demand prudent management, he's going to demand low expenses, he's going to demand to get his fair share of whatever returns the fund makes, his or her fair share of whatever returns the fund makes.
And those, let me stop you there, those kinds of funds exist out there, right?
They do exist, and in spite of the chaos we have in our financial system, well known to everybody, they still exist in a few places, but not nearly enough. So there are places you can move your money and get a much better deal in the places you are now.
All right, so aside from Vanguard, name names. There are some funds out there that represent the kind of values that you think serve investors.
There are some funds, very few. I like Longleaf down in the south. They run the funds as fiduciaries. I like Dodge and Cox out in the West Coast. They run the funds as fiduciaries. And they aren't firms that have 200 mutual funds to run. They might have 4, 5, 6, something like that. And so they can do it that way. They have an international stock fund, domestic, and so on. So they can do that. And another firm that I certainly think highly of is T. Rowe Price, who's having a very good performance streak at the moment. Won't last forever, I'm sure. But they could so easily reduce their management fees because they make an awful lot of money, and instead of keeping it for themselves, the management company and its officers and publics, they've got public stockholders, and it's the no man can serve two masters again. I tell the story in my book about how let me say 15 years ago, I wanted to keep my eye on certain mutual fund companies that had public stock. So about 100 shares of T. Rowe Price for $4,000. Last year I got a dividend from T. Rowe Price of $4,200. This is a profitable business. The capital value of that little investment is probably $350,000 now. And that's great for the shareholders of T. Rowe Price, but if some of that money had gone to the fund shareholders, their performance, which I want to emphasize has been good recently, would have been even better. So the conflict comes up again and again. So the Adam Smith solution is moving your money to people you can trust.
So Jack, in fact, and you and I have talked about this before, investors are making decisions and they are voting with their feet. And they are moving from actively managed funds to index funds,
right,
passive funds, which an industry that you created. So tell me about that movement and what that is telling you.
Well, it's absolutely stunning because in the last 6 years, the industry has had $200 billion taken out of equity funds, okay? That consists of $600 billion going into index funds and $800 billion going out of actively managed funds. That is a tsunami. I hope I got that one right.
You did.
That's a tsunami. So it's happening, and it's going to happen even more because right now, with everybody searching for income, the index funds take maybe 3% of your income as a management fee, and the actively managed funds, I'm glad you're sitting down, take about 60% on average out of it. High expense ratio, and you can see the math. These funds as a group yield about 2%, both the index funds and the others. And the index fund charges maybe 5 basis points, leaving you with 195. And the active managers are charging 140 basis points on average, taking that 2% return.
Right.
So you get 0.7 and the manager gets. So if you're looking income, the handwriting is on the wall. Index funds are going to grow even faster. But if you're just looking for total return, the same thing is going to happen. So
fees really matter.
Fees
a
really,
lot.
The correlation, the one thing everybody agrees on is costs matter. And even Morningstar, the eminent mutual fund rater, says that if you just look at a fund's cost, you will do a better job in selecting future winners than you will if you follow their somewhat complex recommendations. So that's a concession, and that's good in their part because it's true. So that's the Adam Smith solution. Investors act, the invisible hand changes the system.
So it's interesting because so many people have looked at the outflows from stock mutual funds and they've said, oh, investors are risk averse, they're leaving the stock market, they shouldn't be leaving the stock market. But in fact, when you go out and talk to individual investors, and of course you've got this whole community called Bogleheads, which follows your every move, which is really cute. They have conventions and newsletters and everything else. But when you talk to individual investors, are you finding that in fact that they don't like stocks anymore, or that it's just that they don't like paying up for management?
They feel that active management has failed. They feel that active management has lost their trust because active management has always been in trouble because of its costs. And think about it this way. Supposing the market yields 7% in the future. Not a bad number, probably. The index fund is going to deliver you 6.95. And the active manager is going to take at least 2 percentage points out and give you not 7, but 5. And if you put 7 and 5 on a compound interest table for 25 or 50 years even, long-term investing, you will find that you have about a 75% reduction in your capital at the end of the period if you buy the high cost fund. It's not complicated, it's all the math.
Now that, of course, is assuming that the actively managed fund that you buy is going to perform like the market. Now, we spend a lot of time on WealthTrack identifying active managers who are invested in their own funds, who put their shareholders first because they're shareholders too, and who have a history over the long term, let's say 10-year compounded returns, of outperforming the market. So in the one area of human endeavor, why do you think that we can't expect some human beings to do better than the market on a, over the long term?
Well,
why exclude them?
history is not kind to that idea. And a big part of my new book is about reversion to the mean, the fact that above average managers become below average managers and then average managers. And I have 8 charts in the book, and I compare the cumulative return of the 8 major big performing funds of the modern era really, and with the S&P Standard & Poor's 500 stock index. And every chart looks like it'd be laid on every other. Beating the index, beating the index, beating the index, losing the index, losing the index, losing, and ending up exactly even to the market. This is an expectation, and actually they'll often lose because of the cost, but the pattern, when you go through that chapter of the book, you'll say, I've seen this somewhere before. So it's hard to pick managers in advance. And part of the reason it's hard is we look back and say we expect managers to do in the past what they've done in the future. And that becomes somewhat ridiculous for almost everybody. We kept the April 2000 edition of Money magazine, and it was laced with ads saying our 5-year average return is 43%, or we earned 105% as the era of the great boom in technology stock.
Always versus the S&P 500, right?
Yeah,
Not
but 100% you don't
costs.
need to compare it with anything. And we looked at those funds, took the average return. I think the average gain over the market was maybe, say, 30% a year. 30% a year. And 5 years later, those funds had all gone down.
Reversion to the mean.
Reversion to the mean and below. Well, these were hot funds, and they just go. They're on a very bad track, and so they go out of business. And what a lot of people don't realize when they look at history, they say, well, the mutual funds haven't done that badly over the last 10, 15 years. Half of them have gone out of business. You don't see their records. You see the records of the other half that are surviving. Survivor bias. And so you think, pretty good industry. Well, not if you look at people who are investing in 100% of the funds. And then there's the other mathematical fact. The markets are quite efficient, not perfectly. Managers compete with each other. They all believe they're above average, naturally. They all believe they can beat the market. But the reality is that the mutual fund managers are, by definition, average. They have to be, because they own all the stocks in America as a group, pretty much. And so if somebody's winning, somebody else is losing. And to make matters worse, they're losing. Some win and some will lose. But that's when you look at the returns before cost. Look at them after cost, same pattern that I described earlier. So, it's nice to think we can pick good managers. I hope your guests prove to stay the course and win. But I just check them out a little bit every 5 years or so.
So let's talk about the Wellington Fund, which you actually mention in your book, The Clash of Cultures. And the Wellington Fund, where you just told us you started in 1951. And when you started, it was a small fund, and it was had fiduciary standards that it employed. And as you tell us in the book, it too went astray at one point. You were there when it did.
I was there when it did.
And so tell us about what happened with the Wellington Fund.
Well, I tell these stories about the Wellington Fund because it's a great investment lesson in it. And the theme of the book, Clash of the Cultures, is a speculative culture has crowded out the culture of prudent long-term investment. And so Wellington Fund, that chapter is called The Rise, the Fall, and the Renaissance of Wellington Fund. So we were a perfectly good little balanced fund in the 30s and in the 40s and into the 50s and even into the 60s. A little bit better than average performance, largely due to our low costs, but not a huge differentiator. And we were a good competitor. We started to grow. Everybody liked the ideas of Wellington Fund. And then the performance slipped in the early 60s. And I was given responsibility to do whatever it takes to fix the Wellington Fund and Wellington Management Company. And I did a really dumb thing. Overly self-confident, ignoring the lessons of history, ignoring the fact that managers don't endure forever, forgetting about our friend RTM, reversion to the mean. And so when the fund slipped, I thought, A, we needed new managers for the fund. B, I thought we needed to offer, this was the go-go era of hot stocks and hot funds, I thought we needed to have one in our, quote, product line, quote. Make the, if nobody was going to buy a Wellington Fund in those conditions, we should have a fund they would buy. A marketing decision, and therefore a stupid decision. And I also thought we ought to get into the pension fund advisory business. And I had to was able to do all three of those things with a merger, where I gave up a little more of the stock in the company than I should have to get the merger done. Much smaller firm. And so the performance continued to get worse under these people. And in fact, it blew up.
Blew up.
It was a catastrophe. The new managers decided to turn Wellington Fund into something it had never been, a speculative fund, higher turnover, lower class of stocks, a much higher stock position, like 82 or 3%.
Instead of the balance.
Instead of 65%. And they, what happened was, and these stocks were riskier, the companies of tomorrow, he rolled his eyes, and they weren't. And so the fund had a ratio, we call it beta now, of volatility relative to the market of 103, when a fund 65% in stocks should have a volatility of
under
65.
Right.
And so here it was, almost 100% higher.
Yeah.
And
so it blew up, and you were.
It blew up. The assets plummeted. It had been at $2 billion, one of the largest funds in the industry when this started. It plummeted to $400 million.
Painful. But
it was painful, particularly to me, because my great mentor, Walter Morgan, had trusted me to save the Wellington Fund.
Right.
He loved the name Wellington. He named it Wellington back at the beginning, or almost at the beginning. And so here I was. So first I had to get the company started. This is right when Vanguard came along in 1974.
right, when you started Vanguard.
When I started
exactly,
Vanguard.
it's a low cost.
And we started with a mutual structure. That had to get done. That was not easy. Vanguard is owned by its stockholders and not by an outside entity.
And still the only one, right, in the mutual fund industry
The
that
only
is?
one.
The only
And
mutual.
So we operate at cost.
Mutual fund, yep.
No profits to the managers, which are huge in other cases and gives a big advantage. And that was another kind of part of the equation. And have a long-term, prudent focus, and focus on income and not capital growth any longer. Well, by the time I got the mutual structure in 74, the index fund in 1975, we went no load in 1977, and started a whole new way of running municipal bond funds. In 78, it was time to fix the Wellington Fund. I had nothing else in my mind. So I drew up a plan to bring it back from whence it came. And so there we were, and I laid out a memo. See, now I'm no longer running Wellington Management Company, but I'm chairman of the board of the Wellington Fund. And so the management company may have fired me, but they can't tell the Wellington Fund directors what to do. We can tell them what to do. And I did tell them what to do. I said, we want you to bring the income, this all as were counted in the book, from approximately 52 cents a share in 1978 to 92 cents a share. And I'm going to give you 6 years to do it, and approximately. And the portfolio manager said to me, well, that means we have to, you're telling me to sell my growth stocks and buy income stocks. And I said, I'm not telling you to do anything. Just get me the 92 cents and do it without increasing the bond position. You got to leave the bond position cutting back to 35%. That'd be an easy way to do it. And so, of course, he had to do what I told him he didn't have to do. Get into much more income-oriented stocks. I actually gave him a portfolio of 50 stocks to get him started. And they actually turned out to have 25 of those stocks in the initial portfolio. And ever since then, well, it took a couple of years, and then the fund started to march forward, onward, and upward in a dramatic way. We beat the balanced fund consistently ever since about 1981, the average balanced fund, and by the time the period was over, by an enormous amount. And the fund, which had gone from $2 billion to $400 billion, is today, as we speak, $64 billion.
Wow.
So I don't think renaissance is too strong a word.
No, but Jack, what that tells me is that in fact active management can work in beating the benchmark, and even if it's a really big fund, the Wellington Fund has done pretty darn well for shareholders, including, I'm assuming, you.
True.
Yeah,
And
well.
false. And false.
Okay.
Because we, over a long period of time, counting the bad years, have beaten the average balanced fund by 50 basis points, a lot of money, 0.5%. We're like up 8.2% over our lifetime. And
Annualized returns.
Annualized returns.
Right.
And the average balanced fund is up about 7.7. We're 50 basis points ahead.
Which over time is a very substantial
It is
margin.
staggering.
All right, so what's the false? You said true and
10
false.
basis points of that are from active management, and 40 basis points are from low cost. So you tell me.
I see.
You tell
Okay.
me which is the more important.
All right,
That's
so you
4
need
to 1.
both. I see.
Yeah, you need both.
Right. So talk about this speculation that you're talking about in the clash of cultures, investment versus speculation. What is the speculation environment that you think is so damaging to individual investors? And what's your evidence that it is so damaging?
Well, of course, there's plenty of evidence. I mean, the stock market when I came into Wellington Fund was probably trading 5 million shares a day. And today it's trading, I don't know, 6, 7, 8 billion shares a day, depending on the day.
And what's wrong with that? I mean, why is that bad for individual investors?
Well, what it means is, I mean, you don't have to participate in it. That's the beauty of the index fund. But it means that investors' trading costs alone are going to cost probably somewhere between half a percent a year, just the turnover costs.
I see.
And 1.5%. And then to get these great managers, you're going to be paying them an average probably 1.25%, something like that. So all of a sudden, you've got 2 percentage points out of your return, just out of cost, many of which are generated by high turnover. Mutual fund turnover when I came into this business was about 18% a year. Now it's 100%. So it costs, but it has to cost, because there's obviously, think about this for a minute, there's no basis for investors to win if I'm trading all the time with you, because your fund is going to win or lose, or my fund is going to win or lose, but the net value created is what's siphoned out of that by Wall Street, the great croupier of the market casino. And so there's just no way of getting around that. Now let me give you another in a way more poignant and broader example. Everybody agrees that I've talked to, and everybody knows anything about economics, and people in the business, Lloyd Blankfein of Goldman Sachs, if I can use him as an example, maybe reluctantly, agrees, Mary Shapiro the same thing, chairman of the SEC, that the principal function of the financial markets is for them, what I call the financial system, that provides the oil that greases the wheel of capitalism. So let's think about that. We're supposed to be directing new capital to its highest and best and most profitable uses. And we do that at Wall Street. Each year, about $250 billion, Wall Street raises about $250 billion to direct to the most promising companies, either initial public offerings or secondary public offerings each year. And that seems like a lot of money. So we'll call that investment.
So Jack, let me stop you there for 1 second, because we've forgotten what the beauty and the purpose of the markets is, because you are a great fan of the capitalist system and the role that the markets play, so that the essential role of the stock markets is what?
Capital formation, directing capital to its highest and best uses. The companies that make the best products and services at the most reasonable price, the companies that are the best innovators, all the places where future productivity, future economic growth,
jobs,
whence it's going to come.
Right. And you have a really terrific example of how skewed away from that purpose the markets have become. So share it with us. That was in your book.
Well, that $250 billion, which we talked about, is what we'll call investment.
And these are, and let me just stop you there for a second, because the $250 billion you're referring to in the book is that these are IPOs, or new offerings or secondary offerings of companies. So in a given year, let's say last year, there were $250 billion of stock offerings.
Exactly. And compared to that, when we trade, gamble, speculate, that's all it is, trading stocks with one another, they don't go anywhere, and paying off the casino croupiers, we do $33 trillion. So what this means is, if you want to look at it in that rather harsh mathematical way, that 99.2% of what Wall Street is doing is speculation, and 0.8%, less than 1%, is long-term investment. The invisible hand is only working at the margin, and it's going to take a long, long time to work, and in the meanwhile, time is money. If it didn't matter, but over time, those costs that are eroding investor returns, just accumulate more and more. I call this the tyranny of compounding long-term cost overwhelms the magic of compounding long-term returns, and it's absolutely true. So I think we need to do something faster, and it's not going to be easy. I think we need a federal standard of fiduciary duty.
Jack, tell me about this fiduciary standard legislation that you think needs to be passed.
Curious thing is, it's already in the Investment Company Act in the preamble, and it says mutual funds must place the interest of their shareholders ahead of the interest of their officers, directors, investment managers, and distributors. It's crystal clear, and then it vanishes from the 40 Act. There's nothing about implementation. There's nothing about measurements. There's nothing about penalties. So it's there, and we have to put, one might say rather crudely, a little meat on the bones of that statute. And for all institutional money managers, now whether it's pension managers or mutual fund managers, they have to put the interest of their client first. Now what does that mean? Well, first it means prudently investing with a long-term focus rather than speculating with a short-term focus. And number two, it means sort of a corollary of that is not having this costly turnover trading stocks with one another. It's by definition a loser's game. Three, it means reasonable costs. Four, it means...
What's a reasonable cost? Just
well,
to give
that's
us
a good question. I mean, I would say the mutual fund industry now probably operates at around 1% a year. And
of a fee that they actually, management fee they take out of the
right.
mutual fund's performance.
Yeah, and it's very large when you look at, first the fund managers get it, this is a crazy business. Even if they have terrible performance, they still get their fee. And that really doesn't make a lot of sense. But in any event, that the fee is an important thing, and I don't know that we can draw a bright line on fees. We can make broad judgments depending on the kind of fund, the size of the fund, and all those things that go into it. And so that's another issue. Another important issue I should talk about in the book is mutual funds as participants in corporate governance. Mutual funds control 33% of all the stock in America, roughly. And what do we do about corporate governance? Nothing, or almost nothing. The reality is that no mutual fund, with maybe one exception, has ever in history placed a proxy proposal, a proposal on a corporate proxy opposing management. Part of that is a very tricky little conflict of interest issue, because these institutional money managers are running portfolios for the corporations that are in their own portfolios. So they don't want to lose their clients. You know, if IBM is your big client, to take an example, you don't want to vote against IBM's management. Doesn't seem like wise. Everybody denies that I am right on this, but I still follow the old rule. There are only two kinds of clients that we don't want to offend: actual and potential. And that is a lot of clients.
It's a lot of clients.
That's actually everybody. So, and another thing is conflicts of interest. All conflicts of interest should be eliminated. Now, roughly 38 of the 50 largest mutual funds are owned by financial conglomerates, and about 6, let's say, are owned by, are publicly owned by the public.
Right.
And all those directors of those 44 companies have two sets of fiduciary duties, one to their own shareholders and one to their own mutual funds. And in the nature of this business, it's their own shareholders who get honored first. It's not just all those public companies and conglomerates, but even the privately owned companies have conflicts. They want the managers, the owners of the owners of the private companies want to make as much money as they
Sure.
can. And even mutual companies, of which Vanguard is the only one, have certain pressures that make it difficult to do. So we've at least got to get rid of the obvious conflicts.
In order to right the system, as you see it, the financial services system, what's the most important thing that can happen to protect the interest of individual investors?
Well, since I think the Adam Smith solution, the investors voting solution, is too slow, the most important thing that can happen is a federal standard of fiduciary duty for all money managers, institutional, individual, whatever. Put the client first. It's not complicated. It's also, by the way, we found at Vanguard a great business strategy. I mean, think of General Motors, think of IBM. They're putting the customer first. That's a little different, but our customer is our client.
In your book, The Clash of Cultures, you have 10 investment rules for individuals. Let me just quickly take you through them and just tell us.
Sure.
Remember reversion to the mean. What do you mean by that?
Okay, that's probably that's number one of the rules, and that's the most important of all. And that is, we talked a little bit about this earlier, but that means that don't look back at past performance, because all mutual funds, one way or the other, if they do very well in one period, they will do badly in the next period. If they do badly in the first period, they'll do well in the second period. It's so clear in the industry data, and the only thing you can say to balance that a little bit off is high-cost funds don't do quite as well in the good periods and do a little worse in the bad periods, so cost remains a factor. But reversion to the mean means don't think the past is prologue. It rarely is, and sometimes it's anti-prologue.
Number two, time is your friend. What do you mean by that?
Think of the value of compounding. Get yourself out a little compound interest table and see that at 7%, money doubles every 10 years. And then it doubles again, and then it doubles again, and then it doubles again, and doubles again, and doubles again. And by the time you're at retirement age, if you start investing when you're 50, it's multiplied, you'll have to tell me, but let me say 35 or 40 times over. Unbelievable, maybe even more than that.
Three, buy right, hold tight.
Okay, buy right, hold tight means don't make mistakes at the start, pick a good fund, and hold it through thick and thin. And I would argue very strongly, if you're looking at an actively managed fund, and you should be very careful to buy the low-cost ones, even if it's actively managed, that don't get despondent when it does badly, because it comes and goes. So hold tight, buy right, hold tight means don't let yourself be diverted by changes in the manager's performance, unless it's grossly excessive, and by changes in the market. You know, we had all these years of 17% annual returns in the 80s and 90s, and people were surprised, I can't imagine why, that we had essentially zero return on common stocks in the first decade of the 21st
Reversion
century.
to the mean again.
Reversion to the mean, absolutely.
Have realistic expectations. In this new normal, what's a realistic expectation?
Well, I still think Bill Gross, who does the new normal kind of idea, is a little bit below me, but I think common stocks should earn a nominal return of around 7%, nominal meaning before inflation. And I don't make that up. I think the dividend yield is a very, very important thing in this, and that's 2% today. So corporate earnings should grow at about 5% in nominal terms. I think that's about right because corporate earnings grow at the same rate as the economy. Even over short periods, the annual correlations are remarkably high. And so you can look with reasonable expectations for a 7% return. Don't look for 11, don't look for 15, don't look for nothing, don't await the coming of the next bear market. Those are all guesses. And you know, some of those guesses will be good, some not so good. But so there's the 7% that will double your money every 10 years. And if that happens, it's the high odds, it should be good sailing, but below the long-term norm of 9% because of that lower dividend. Now, one thing that trips us up when we get into these returns is that there's one other. I gave you the formula for the investment return or fundamental return on stocks, which is dividend yield plus corporate earnings growth. Because the stock market doesn't contribute anything to this. It's corporations that do that. They got a lot of capital, they invest it well, they pay out dividends and reinvest the rest. This is not a complicated system. So you go that far with investment return. There's always this nasty little element of speculative return. And then if the multiple of earnings, the amount people will pay for a dollar of earnings, goes from 10 to 20, say, that's a double, and over 10 years, that's an addition of 7% return. So if it doubles in this coming period, that would take that 7% up to 14%. Is that likely to happen? No, it is not. It's almost inconceivable. Because the price in the market, it seems to me, is roughly fairly valued today at around, people use all kinds of numbers. I use sort of a central number of 16 times earnings. And you know, if it goes to 18 times earnings or goes down to 14 times earnings, that's not going to, over 10 years, that's not going to affect that 7% very much. If it goes to 25 times earnings, I can't imagine it. That would take the earnings way up. And if it goes to 4 times earnings, which is really pretty inconceivable, that would take it down. So I look for speculative return to add nothing or subtract anything from that investment return. And the interesting thing about that is we think so much about speculative return, day to day, year to year, decade to decade even, but in the long term, say 100 years, speculative return is going to be zero.
So don't pay any attention to it.
If you can avoid the behavioral temptations, absolutely.
Forget the needle by the haystack, you buy the whole market. Why?
Yeah, well, because buying a good manager is like looking for a needle in a haystack. And everybody knows what that's about. Good old Don Quixote had it about right. And so it just makes common sense. Own the whole market and not just a few stocks. You don't need to take the risk of individual stocks. Take the market risk, which is quite high enough. You don't take both.
We talked about this before, but it's minimizing the croupier's take, and which means that just go for low cost.
Go for low-cost
Right.
funds and especially index funds.
There's no escaping risk.
Think about that for a minute. I don't like the risk in the stock market. So put your money in a savings account, a certificate of deposit. There's no risk there. Wait a minute. The return there is probably going to be about 1.5%, and we're going to have 2.5% inflation. So the real return is essentially, and this has been true all over history, that the return on a savings account, the nominal, not the nominal return, the real return, the nominal return of say 1.5% at the moment, very, very low, turns into a real return of -1%. So is there any risk in putting money in a savings account? You better believe it. And everybody needs a little bit of an anchor to windward, but keep that low. And of course, in these days with the money market, I would strongly recommend short and intermediate term corporate bonds to replace at least part of that, because the yields there at least exist. Saying something these days.
Beware fighting the last war.
Everybody, I mean, a great example is people started to worry about inflation about 20 years ago. And so we had funds, inflation beaters fund and all that kind of thing. That was the last war. Inflation then pretty much stopped for a long time. And the inflation that we had from, let me say, post-World War II to, say, around 1980. And we always have some inflation, but it got to be 6, 7, 8% in some years. And so people want to protect themselves about that. They forget that if you look at the wholesale price in London, one good measure of inflation, the prices before World War I were exactly what they'd been at the time of the Great Fire in London in 1666. That's a long time to have no inflation, but you never know what's going to happen on that front. So part of that caution is your job is to get the biggest gross return, because inflation is going to take whatever it takes out of that return. And if it's a big return, it will move it down a little, but if it's a little return, it will eliminate it. So you want to think of you never want to forget that.
Couple more in rules for investors that you want to share with us. The hedgehog beats the fox.
That's one of my favorites. I didn't make it up. There's a Greek poet back probably in the 3rd century BC named Archilochus, and they found a little fragment of Archilochus' writing, and it said, "The fox knows many things, but the hedgehog knows one great thing." And in our business, the foxes are all those managers who are smarter, they got all those computers, all those brilliant Harvard Business School graduates, armies of them, and they know everything. They know far more than I could dream of knowing. I know one great thing, and that is if you own the market, which they do collectively, naturally, if you own the market, you are guaranteed, in a low-cost index fund, you are guaranteed to earn your fair share of whatever the stock market is kind enough to give us, and let's be very clear on this, whatever return a bad market is mean-spirited enough to take away from us. So it's the hedgehog who wins. And the poor fox with all his wiles and his marketing department who figures out what everybody wants, all those crazy things that go on in our business, he's yesterday. And he's going as fast as I can get rid of him.
You're doing a pretty good job of that as well, I might add.
So far, so good.
And your final rule for investors is stay the course.
One of my favorites, I use a lot in the book, and that is the best thing to do is behavioral. Let me start with this premise. Most investors, many investors, probably the majority, lose because of their own behavior and not because of how stocks and bonds do. They are trailers. They buy something that's done well and think it's going to do well in the future, and it doesn't. They a whole lot of bad behavioral patterns. If they find a hot manager, they jump on the bandwagon, and that doesn't work. They just can't do it. And the markets are really, just think about this for a minute, really counterintuitive, because when do you feel you're most optimistic and most happy and enthusiastic about buying stocks? At the market peak. When are you scared to death about stocks and really want to get out? At the market bottom. So you get in at the top and out in the bottom. Do you think you're going to do well doing that? So figure out a sound program, I would argue, one with an appropriate part of bonds and bond funds, really, and stock funds, index funds, I would say, in both cases, and let that allocation favor bonds a little bit more as you get older, and finally quite heavily when you get to retirement, and almost all in stocks before you start down that road. And that's a good formula for working. It doesn't have to be a formula, but a good rule of thumb, heuristic, as the academics would say. And so that's what staying the course means. Set the right course, and then don't let all these superficial, emotional, momentary things get in your way. Another way of putting it is, don't do something, just stand there.
So, Jack, the one investment that we should all own in a long-term diversified portfolio, what would you recommend that we all own something of?
Total U.S. stock market index fund. Period.
And I have to say, Jack Bogle, you are an investment giant. You are a tireless advocate for the individual investor, and I can't thank you enough for staying the course throughout your many-decade career. We are all the better for it. So thanks so much for joining us on Wealth Track.
I love your closing line, and thank you. It's great to be with you.
Thanks, Jack.